Margin is the difference between revenue and expenses, whereas efficiency measures how well it can transform things like materials, labor and capital into products and services that produce revenue. We covered how to arrive at these two measures in our last video. Let's understand more about ROCE, ROACE and their relation with margins and efficiency from our expert Marie-Lise Lechera, trainer from ML2 Formation and Council.
Let's open together the Total Financial Communication, this famous worldwide operating oil and gas company. They make public a very interesting measure, which is the ROACE. I know some of you may feel like, oh, come on, we just introduced the ROCE and now we have to move on to the ROACE. And I know it is a bit frustrating in finance. There are so many metrics. There are probably as many metrics as companies. But let's not panic. What we've learned will be helpful. Let's see how different total ROACE is as compared to our own return on capital employed. So look, that's the definition we decided upon for the ROCE. Operating income divided by capital employed. How does Total adapt this formula? Well, at the numerator, the first thing they do is they take the net operating income. What does net mean? Net means after tax. Assume, for example, the tax rate is 1/3. So they are saying, look, we've generated a certain amount of operating income. We're not going to keep for the communication this full operating income. We'll consider that 1/3 should go to the government through taxes and only 2/3 would be kept to reward our fund holders. It makes a lot of sense to communicate in that way because the numbers they make public are intended to shareholders and shareholders are rewarded after taxes. So that's the first adaptation they do. The second adaptation they do at the numerator is they take an adjusted net operating income. Adjusted means excluding the non-recurring items, excluding the exceptional gains and the exceptional losses. So basically they show a performance that we can judge to be sustainable over the long run. And at the denominator, what do? They don't take the capital employed at the end of the year, but they take an average capital employed. They do an average between the numbers at the beginning and at the end of the year. Again, so as to get rid of any exceptional fluctuation. Many companies do that, it makes a lot of sense. And at the end of the day, ROACE stands for Return on Average Capital Employed. So the formula is different, the numbers will be different in the end, but it's not a big deal, let's not panic. Actually, the underlying concept is exactly the same. It still highlights the overall performance of the operations, and the drivers of that performance will still be margin and efficiency. Let's look at the numbers now. So, the ROACE of the entire company, it was 9.8% in 2019. It would be more interesting and more fun to look at the numbers at business unit level. So actually, Total carries 4 business units. Oil exploration and production is the first one and the biggest one. Integrated gas, renewables and power is the second one. Refining and chemicals is the third one. And marketing and services is the fourth one. What do they have under marketing and services? Essentially the petrol stations that you can find downtown. So these are the 4 business units. Can you guess which one had the highest return on capital employed last year? And that's been the case for the past years, actually. Let's look at the numbers together. That's the situation. And I bet some of you are pretty much surprised by the results. The business unit that carried the highest ROACE last year was refining and chemicals, closely followed by marketing and services. Exploration and production had an ROCE that was below the group average. So did integrated gas, renewables and power. That's a bit counterintuitive because I think most of us were biased by the margin dimension. And we feel like intuitively, marketing and services, refining and chemicals are not business units where Total adds a lot of value to the products. So they shouldn't carry too high a margin. And that's why we jumped to conclusions and felt like they wouldn't have a good ROACE either. But that was forgetting about the efficiency dimension. And yes, refining and chemicals, marketing and services carry low margin levels, but they are very, very efficient business units.
Drop us a comment on whether your current department is high on margin or efficiency, or whether it's a good balance of both. For more business courses, check out the link in the description. And to continue understanding financial statements and key metrics, press the bell icon and subscribe to upGrad Management.